Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. I want to welcome you to part 3, the final part of my 3-part series on dissecting the Dow Jones Industrial Average. Today in part 3, I'm going to refer to it as the big tech version because I'm going to be covering 4 very big, high-quality tech stocks that I'm going to also share with you that I believe are overvalued, which is somewhat controversial, but more about that later. The idea here is that, the Dow Jones, the 30 stocks in the Dow Jones have been a proxy for the stock market since I've been in the business, and that's over 50 years. And it's a good little index, has 30 stocks in it. It really covers all the sectors, as I mentioned in parts 1 and 2, except the real estate sector. There's no REITs in it, and it also doesn't cover utility stock currently. But otherwise, you're looking at a broad cross-section of the market. And so it gives you a good proxy because of its small size. You can actually look at all of those stocks and get a real good sense of what valuation was. In part 1, I covered the most attractively valued of the 30 Dow Jones stocks. And there were about 10 of them. About a third of them were reasonably valued, but not all of them were great investments because value is only one part of the equation. You also have to marry value with future growth because that's where you're going to make your money. If you buy value, you're going to participate in the future growth of the business. If that growth is going to be weak, you can expect your returns to be weak. If that growth is going to be very strong, you can expect your future returns to be very strong. But even for very high growth, you can overpay for it. And you can even make up for low growth by finding really undervalued stocks that allow you to get what I call natural leverage, where you can get the potential for a little bit of growth, maybe some nice dividend income, and then ultimately some multiple expansion or price earnings ratio expansion over time. So there's a lot of ways to skin the cat. But one of the primary messages that I want to get across, especially with this part 3, is its awareness, okay? In other words, there's a difference between investing and speculating. When you're investing, you're generally positioning your money into a good business, a great business, where you are in a position to participate fully in the growth of that business because you're buying that business at an attractive and reasonable valuation, somewhere close to its intrinsic value, in other words. Never perfectly, but close. When you overpay, then even if the business does great, you might not get the rate of full measure of the return that the business generates because you overpaid for it. And then if you buy a business at significantly undervalued levels, you can actually get more value out of that business because you're going to get that PE ratio expansion I talked about. But the key point here is awareness. So let's go ahead and get into the video here, and let's look at this last section, or the last 10 stocks in the Dow Jones Industrial Average. And the companies I'm going to be covering 4 information technology stocks: Salesforce, Visa, Microsoft, and Apple. And I'm going to feature really Apple. I'm going to probably spend the most time on Apple as I go through this because I've had regular viewers of my videos often talk about Apple and they get really upset. And I always try to explain that I consider Apple to be my favorite company in the world. I love Apple. The only thing I say about Apple is I do consider it overvalued today. I don't consider it a great buy. That doesn't mean that I'm simultaneously saying that you should sell it. It simply means that it's not a good buy, and it contains a level of risk right now that is not commensurate with the fundamentals that the company is capable of generating going forward. And again, I'll cover that in more detail as we go through. But I like to organize. I want you to note that you've got some really high quality companies here. You've got 3 in the triple B, 2 in the triple B plus, 1 in the B minus range. But the rest of these are A all the way up to double A plus, and then finally triple A with Microsoft. So these are really creme de la creme stocks. That's another attribute about the Dow that I really like. But I also want you to look at earnings yield. The price earnings ratio, I've often talked about a 15 PE ratio as being my valuation threshold for what I would call normal growth. Companies that are growing at, 8 to 10% a year or 6 to 8% a year, historical norms. When you start getting above that, when you start getting 15 and 20% growers, then you can use a higher multiple. You can pay a higher multiple in that because of the power of compounding. The faster a company's growing, the more future earnings it's going to generate, and those future earnings are going to be able to reward you. So you can buy a very fast-growing company with a lower earnings yield than you can a slower-growing company. But having said that, let's talk about what earnings yield is all about. I consider this to be the most important metric. The PE ratio is simply an indicator of this metric, and the inverse of the PE is earnings divided by price, or earnings yield. And this tells you that if you owned 100% of the company and the company paid you every dime's worth of profits they make, what would be your return? In the case of, for example, Disney, it would only be 1.3%. In other words, you would only be earning 1% if you got every dime that Walt Disney basically paid you. Now, the growth expectation for the next couple of years is expected to be very high, but part of that is a little bit of a misnomer because it's coming off of some really, reduced earnings that happened during the COVID pandemic, and I'll get into that in more detail. But, I'm looking for 6.5% to 7% earnings growth, and none of these 10 companies meet that bill. Even Apple only offers a 3.5%, 3.57% earnings yield, which means all of the company's profits being paid to me would only give me a 3.5% rate of return. And I'm basing that, on a blended PE ratio, which is the most accurate PE ratio you can have, because it's part past, part present, and just a little bit of the future. So it's not forecast estimates. It's really looking at what Apple's actual earnings really are, or any company. And then Boeing has no earnings yield because right now the company has negative earnings, but that is also changing. Again, statistics don't lie, and statisticians are darn liars, but you've got to basically look beyond the statistics and think. So let's go ahead and go through these companies, and I'm going to start with Boeing, since I already mentioned. Now, as I do with all these videos that I do, I want you to notice, from a historical perspective at least, the very profound relationship between price, which is the black line on this graph, and the earnings, which is the orange line on the graph. And that's the intrinsic value line, I like to call it, or it's the fair value line. The blue line is the market value line. The market value and the intrinsic value are not the same thing. There are times when market value gets completely disconnected from intrinsic value, and being able to recognize that is one of the great attributes of the fast graph tool. But when you look at Boeing, you can see the company's stock price tracked its earnings, very consistently year after year. When earnings were rising fast, the stock price rose fast. When earnings were dropping, the stock price dropped. And then, of course, we had COVID, and then we also had the issues with their one of their major airplanes that, we all know the story. I can't remember the name of the airplane now, but anyway, I apologize for that. But so the company has had very poor earnings. Earnings, they lost $3.47 a share in 2019 and $23.25 a share in 2020. And now they're expected to lose about 89 cents a share, which is a significant improvement over what they lost last year. And then by 2022, they're expected to start generating positive earnings again. So the reality of it is, you're really looking to the future with this company. But at this point, there's no earnings yield. They've completely cut their dividend. This is obviously would be a speculation now, but what's interesting is you can see that the price reacted very dramatically to those losses. The company's down over 60%, since February of 2019. Now, it has rallied quite strongly, anticipating that the future is going to be better. But there you have to be careful when you're looking at the forecasting graph. If you're willing to look out to 2023 or 2024, this business might start to look good, but I still would believe that this is an expensive price to pay for Boeing. But the key point here that I'm trying to make when looking at something like this is you're dealing with a high level of risk here. You have the uncertainty of the future earnings, you have the certainty of the recent losses, you have the certainty of the eliminated dividend, and it becomes now very, very difficult to try to come up with a real true valuation of this stock. So to me, it becomes a speculation. The company also is very debt laden, as you can see here at the bottom of the graph. So that's Boeing, and that's one of the constituents of the Dow. The next company is Walt Disney. Very similar story. It's interesting. You have this long-term relationship between earnings and market price. You have periods where the price gets disconnected from earnings, like it did here, peaking in July of 2015, which led to almost 3 years of negative returns for shareholders as the stock price reverted back to its intrinsic value. And then, of course, you had COVID and all the things that happened with COVID. They completely eliminated their dividend for a while. The earnings collapsed. They had a 19% drop in fiscal year 19, which, by the way, ends in September. And then they had a 65% drop for fiscal 2020, which ended in September. And now they're expected to see some good growth going forward. So there is some forward potential here, just like we saw with Boeing. And at some point, the analysts expect Disney to start growing at pretty attractive rates going forward. The long-term growth rate is staggering, but this to me is really it's anomalous, because what you're looking at is the idea that you're taking the earnings growth from these very, very depressed earnings and then moving it back to normal. So you've got to be careful when you're looking at these companies that you understand what you're looking at. And that's what I think FastGraphs does so well. It puts everything into a visual format, so you can just take the numbers and also see what they look like visually. But I consider Disney an extremely overvalued stock here. Great business, great company, probably going to be doing all right in the future. But, price is what you pay, value is what you get, and I don't think there's any value. And again, I want to repeat, what you want to do is be aware of the risk you're taking. McDonald's is another case. And I also want to make a point here. I have never said that this cannot happen. I have simply said that this is irrational. These are valuations that make no economic sense. Yes, interest rates have been dropping, and low interest rates have stimulated people to bid the prices of these stocks up, and they've held up. But you can also see a lot of volatility starting to show up in these stocks, but you're paying a very, very high price. You've got an earnings yield of 3%. You've got a dividend yield of 2% with a very stellar dividend record. But the point is, there is a lot of risk in this stock. If it were to come back down to its intrinsic value, there could be substantial losses or even dead money over the next several years owning McDonald's, even though it's, again, another terrific company. We all know the story. It has an awful lot of debt. If we start seeing interest rates rising dramatically, we see inflation, rising dramatically. Stocks that are trading at these high valuations are vulnerable. Again, the message is be aware of the risk you're taking holding these stocks at these high valuations. If you bought them back when they were reasonably priced, wow, well, have these been great investments for you? They've also been pretty good business performers, but you're getting more than the business has done. In other words, your rate of return from this spot right here, where the last time McDonald's was really at a fair value, which was around January of 2009, and held it to today, you're making about 13.5% a year during a period of time where, if I cut off 4 years here, just to give you a perspective, your earnings growth has been 7.5% roughly, and you've made almost 14%. So you've made double the growth of the company, including adding dividends on top of that. And it's simply because the stock is now currently overvalued. Be aware of the high valuations. Honeywell, which is an industrial conglomerate, you can see, again, the relationship of price and earnings. You can see valuations are reasonable most of the time. They fall within a range. Then we had the stock get really overvalued up to a PE of 21, correct back down to a PE of 17 or 16 and a half or so, rally again, fall back down again when, we had some weak earnings in fiscal year 2020, and now the stock has been bid up again, well ahead of what its earnings justified. And that's the key. You've got very high valuations. You've got a company that's forecast to grow at double-digit rates. And by the way, checking the analyst scorecard here, this company has almost an impeccable scorecard. The only time that the analysts really got this company wrong was during the recession of 08 and 09, and then, of course, during COVID, which a lot of companies, got it wrong because of COVID, because COVID was a 100-year event that really was unanticipated by, the market. There was no way to anticipate what would have happened with COVID. The next stock now is Salesforce Com, and this is an extremely interesting example here. If you look at earnings growth from the period of time, going back to 2005, earnings have grown by over 50% a year. This is an A-plus rated company with a $237 billion market cap. You can see that stock price has followed suit. If I look at the performance of this company, it's averaged over 27% a year compounded, which is, half of what the company's earnings growth has been. But that's simply because the PE was astronomical back when when I started measuring this here. So take some time off here just to do it where you could see it more clearly. We had a PE here of 123. Now earnings growth has fallen to 28%, and you've averaged about 24%, but a lot of that has to do with this very high valuation. I'm going to take a look at this company a little bit later also. Visa. You could have bought this stock at an attractive valuation, as the market should, and then it got pretty pricey. And then since 2016, the stock has just never-endingly gone up. Not denying that, but the point is that is not consistent with the results of the business, and that's the message I want to get across. If I shorten the time frame here, earnings growth has fallen to 16%, where the long-term earnings growth is 20%. So what we have is a valuation, over this period of time, the normal multiple was about 25 times earnings, and that includes these high valuations with these low valuations. I shorten that time frame, the earnings growth has fallen to 16%, okay, and the PE multiples climbed up to 29. So you've got a lot slower rate of growth and a much higher valuation by the market. That should tell you that something's not right there. But yet, I love this stock. I made a great deal of money in this stock. I did sell it early. The price is continuing to rise. But in the long run, fundamentals rule. And the key is, if you own this stock now, it's probably prudent to be thinking about taking at least some money out. Nike, very similar story. We have this long period where the price, tracked earnings somewhere between 15 and 20 times earnings very consistently. And now we've got into this stratosphere. The company's been a long-term grower at about 13.75%. If I shorten that time frame, it's still growing at about the same rate. Okay, I do want to give it credit for that. But the reality of it is it's trading at a valuation that is significantly higher than historical norms. Earnings yield is only 2.2%, and the dividend yield is only 0.6%. And, dividends, as I've done in previous videos, is another way to look at valuation. And, when the stock price is low or reasonable is when you're going to see the highest dividend yield. That's what this burgundy line here, we had a 1.75% yield. At, year end last year, the dividend yield was 0.77%. And now, 6 months later, we're looking at 0.66%. That's another indication that the valuation is extremely high. These are nosebleed valuations. They're not justified by the future growth, even though the future growth is going to be very strong. Chevron is another case where it's a good oil stock, one of the premier AA rated oil stocks with little debt. Oil, we've seen this before, showed it in previous videos. It's just very, very difficult for them to make any money. They do have stellar dividend records, however. They've increased their dividend by over 7% a year historically, so it has a great dividend record since 2002. I also want to point out that if I look at this company from a standpoint of operating cash flow, because really the dividend, currently yielding 5.3% is what makes this attractive. And the dividend yield right now is, up there in the high side. At the end of last year, it was, over 6%. Of course, we've had a little rally in the stock. It's now 5.3%. But these are very high dividend yields relative to the valuation. And the dividend is reasonably well covered by cash flows, but it's getting more difficult. Cash flows are getting closer to the dividend. Your payout ratio currently is expected to be around 90%, or it was 90% for 2020, 91%. So they're actually paying out almost all their cash flow, but now cash flow is expected to improve. Now, this brings me to Microsoft, and I want to make a couple of points on the Microsoft graph. Currently trades at a blended PE of 35, okay? And dividend yield is 0.78, earnings yield 2.8, very low earnings yield. Back here in June of 2000, let me get closer. Right here would be a very close. Right here we had in August of 2000, we had a PE of 35, roughly, 34.9 versus 35.6. I want you to note that that actually led to a long period of time, 15 years or so, of dead money on this stock. Even though the company's earnings, if you watch and follow my mouse here, the company generated great earnings back then. Okay, so the markets can just do crazy things, and they can do it for extended periods of time. I've never denied that or never said that, but this was a very high risk situation. This is coming into the end of the tech bubble. There was a time when Microsoft's valuation was even much higher, but even here it led to decades, more than a decade of weak money. And I wrote articles and did videos on Microsoft back here saying what a great buy it was, and it was during the Steve Ballmer age, etc. People said I was nuts. Today, with the multiple back up here at 35 times earnings, people were saying that, Microsoft is a great company. unarguably AAA rated, low debt, great earnings growth. Earnings growth has actually been accelerating in recent years. From the 11% historical, it's now averaging about 15. It's expected to grow at 13 or 14 for the next couple years and 12 over the next 3 to 5 years, which I think are all achievable growth rates. But this is a $2.1 trillion market cap company. And finally, this leads me to Apple. And I want to cover Apple because I get, I have a subscriber, Subcom, and I'll go ahead and put a call out on him. He keeps thrashing me, telling me I'm wrong about Apple. And I'm not wrong about Apple. The facts, I'm right about the facts. That doesn't mean that I was forecasting the stock price correctly, but I'm right about the facts. And let me illustrate those facts. The long-term growth of this now $2.4 plus trillion company, the company grew earnings historically at over 35%. Had you owned this stock for the last 2 decades, you'd have turned 10,000 into 4 million or 3,900,000 in capital gain plus some dividend income that they've been paying recently since 2012. Okay, but watch what happens when I start changing the time frame. Now I dropped several years off. Now the company's earnings growth is averaging 14%. So I want to be clear about that. We've gone from a company that was growing at 35% to now we've got a company that for the last 15 years has grown at 14%. I watched a video by a gentleman named Joe Hogue, and he pointed out this relationship that Apple, would have turned $1,000 into roughly, the 400,000 that I showed you here, the 338, I think was the number he used 20 years ago. He said, but for it to do that going forward, it would have to grow to an $800 trillion company, which would be 9 times the entire global economy. Just to make, a good solid 10-bagger on Apple going forward, it would have to grow to a company market cap larger than the whole United States economy. That's very unlikely. As he pointed out, these big tech stocks are becoming victims of their own size. Okay, but this is clearly a picture here where you've got a normal multiple on this stock of about 15 times earnings. Forecast earnings growth is expected to slow down dramatically over the future years. To me, that makes sense considering this is a $2.5 million company. Now, one point that was made was how wrong the analysts have been. Like, for example, 6 months ago, analysts were expecting $4.38, and the company is now expected to earn $5.58. That's a huge increase in earnings for this year, but that number still does not justify today's valuation. The point is, I love this stock, my favorite company on the planet. I've said that over and over again. I made multiples on my money owning this stock, and I did sell it, and I did leave money on the table because it was overvalued. But now you also got to remember that I've also reinvested that money where I've reduced my risk dramatically, and I've done very well with how I've reinvested that money in attractively valued stocks. But the point is, I'm not even saying you should sell Apple here. What I'm saying is you should be aware that the valuation has become, ridiculous. Now, the forecasts have been wrong. Okay, the company is exceeding the estimates. But common sense would simply tell you there's no way for a $2.5 trillion company to continue to grow at 25, 30, or 50 or 70% a year going forward. Now, I'm going to go turn to the new version of FastGraphs, which we're getting closer and closer to launching. And I want to look at Apple from another perspective that's not available on the current version, but will soon be valuable, and that's price to sales. Apple has traded at 3 times sales historically. I mean, that's been phenomenal. That's a very high multiple of sales. That's revenues now, not earnings, not cash flow, but sales. And you can see in today's level, it's now trading at 7 times sales, double the normal rate. And you can see what's happened over all these years. And again, I want to remind you that their revenue growth is beginning to slow down. It's not expected to grow as fast going forward as it has historically. And that's just common sense. In fact, revenue growth is estimated to be in that 4 or 5% range. But even if they grow at 10%, which is extraordinary for a $2.5 trillion approximately company, that doesn't justify today's valuation. You need to understand the risk you're taking holding Apple shares. Now, you can continue to take that risk. You can continue to speculate because it's undeniable that this stock is very, very popular right now. It's been overvalued back in, going through 2018. It did revert to the mean where you could have bought it at a reasonable price to sales. And now it's, skyrocketed again. But I also want you to notice that, it's getting more and more difficult for this stock price to travel anymore. Great company, significantly overvalued. I love Apple, okay? And all I'm simply saying is owning Apple today is speculation. The forecast growth of this company is expected to still be extraordinary when you consider a company this size. But the point is, price is what you pay, value is what you get. This is too high a price to pay. This is not a good time to be buying Apple. If you've owned it for many years, could say, you could still continue to speculate. Common sense and maybe prudence might suggest taking some of your money off the table, maybe taking your original investment in 100% profit because you've probably made a lot more than that, and then let some of the house money run. But the key is be aware that this is a high multiple in Apple. Even though it's as great as Apple is, this is simply not a good value for Apple, regardless of what you expect growth to be and regardless of how well they've beat estimates here recently. It doesn't still justify the valuation that this stock is trading at. It's really that simple, and the price to sales, I think, tells the story probably as well as anything. Anyway, this has been Chuck Carnwell saying thanks for watching. This is the third and final series of Dissecting the Dow. I call this the Big Tech series. So, these companies are great. They're the best companies probably on the planet, but they're not stocks that you want to buy today. If you own them, you need to pay attention to the risk you're taking and be prepared to leave if you have to. Anyway, thanks for watching. Give me a like if you enjoyed the video, ring the bell, subscribe to the channel if you haven't. And also, you might want to take a look at a subscription to FastGraphs. We'll be launching this new version hopefully in the very, very near future. And I can tell you right now, it's going to be worth the wait because it's really coming along terrifically. Thanks for watching.